What are interest-only loans? Let's talk about it. Okay, so when interest rates go up, people start getting creative, right? So they don't necessarily go just the fixed rate route. They might go with an adjustable rate mortgage, or they might go a different route known as an interest-only loan. Now, I actually happen to have that on my home equity line of credit. It's my HELOC. It's a loan that's basically a second position. But what are interest-only loans? Well, it's just that. So you don't actually pay towards the principal. You only pay the interest on the loan, and it's usually for a set period of time. So let's say you have a 30-year mortgage, right? So let's take a HELOC, for example. Typically, you'll do interest-only payments for the first 5 years. Then, after that point, the rest of the principal is going to be divided up and amortized over the remaining 25 years. The pros of doing this is it keeps your payments low in the initial beginning. So for example, if you were to buy an investment property, it would increase your cash flow. If you are just trying to keep your expenses down in general, it is an option. And then within the next 5 years, you can decide what to do, whether it's sell the property, refinance, pay it off, whatever floats your boat. Then the con is the remaining payments are going to be amortized over the remaining 25 years, using this as an example. So your payments are going to jump up. Also, depending on how it works, typically the interest-only payments are fixed rate, meaning the rate doesn't change, right? So if you've locked in 7%, it's 7%. And that's for the 5 years. After that, it can be adjustable. So I've seen where it can be as high as technically 15%, which is unlikely, but you just never know. And they're giving you that notice that it can fluctuate in either direction. And they also have a floor as well. So there's pros and cons to it. One of the great things about real estate is you have the ability to leverage it. And then if you're renting it out, something like that, somebody else is paying that off for you. So you get the tax write-offs, loan pay down, right? So even if values don't change at all for the next year, you're still gonna net more money because more of the loan's been paid off. With interest only, none of the principal is being paid off. You could make payments during that time. It's completely up to you, but you'd have that flexibility. I'd love to hear what you think. Would you ever consider an interest-only payment or a mortgage? Comment below. Don't forget to follow or subscribe depending on where you're watching this. You have a great rest of your week.